So if you're thinking of selling your house in this market, you're probably going to have quite a bit of equity. And, you know, do you think you're going to owe taxes on that equity? So here's how you figure it out. Back in 1997, they changed the law. It used to be where, you know, you could have an unlimited amount of equity when you sell your house, so long as you rolled it over into a new house. Well, good news is that rule was changed in 1997, and now you can do whatever you want with your equity when you sell your house. You can put it into a new house if you want, or you can go on a massive vacation around the world. You can do whatever you want, but there are caps now. So if you're single, it's $250,000, and if you're married, it's $500,000, double. So you can sell a house that you bought for $400,000. You can sell it for, let's say you sold it for $700,000. That's a $300,000 difference. So you might be thinking, well, if you're single, you're going to owe taxes on $50,000. Well, that's not the case. So the way it works is you take your cost basis, which would be the $400,000, and you add to that any capital improvements you've made to the house, not repairs. These are more like if you did a remodel, finished your basement. Even if you did the work yourself, you keep the receipts for all the materials and stuff so that you can add that on there. And then you also get to deduct the cost of selling the house. So any kind of realtor commissions that you paid, closing costs. Everyone's got closing costs, probably in the ballpark of $5,000. And so between realtor fees and closing costs, it could be like $20,000-$30,000 that you get to reduce your equity by. So let's say you sold it for $700 minus say $30 for closing costs and realtor fees, and then maybe you finished your basement and you've spent $25,000-$30,000 on it. So now you're back down to where you maybe only made $200, $220, $230. So you wouldn't owe any. It's called the capital gains exclusion for primary residence. You have to live in your house for 2 out of the last 5 years. They don't have to be consecutive years, but yeah, if it's your primary residence, and you can do this, you can repeat this process every 2 years. You can buy another house, maybe you grow an extra $100,000 in equity, and then you sell it, walk away with a chunk of cash and do whatever you want with it. But anyway, that's my tip for today. So keep all your receipts, because when you go to sell, you might want to add those to your cost basis and save yourself some tax.